Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy, with your monthly ETFs, and today we have a big challenge. Who wins between NEOS's SPYI, their S&P 500 High Income ETF, or Goldman Sachs GPIX, the Global Equity Income ETF? Which one's going to be better for a retirement fund between these two strong contenders? Well, we're going to break them all down for you. And before we do, I got to say a shout out to all of our subscribers and all of our Patreon supporters. Thank you so much for supporting the channel and being part of our Patreon, which, technically is free, guys. Everything there is free. We give you as much information as we can, and it's a great way for you to help support the channel. So look down in the description if you want. You can sign up and be a great member. And if you can support it, we always appreciate it. But today, let's get into who's going to win, NEOS's SPYI or Goldman Sachs GPIX for that retirement fund. We do have to do the disclaimer, and that is past performances don't guarantee your future results, and this information in this video is for educational and informational purposes only. I am not a licensed financial advisor. I am just one who's been studying this stuff for years. The example and suggestions discussed here are basically not suitable for all individual situations, so always contact a financial advisor before making financial decisions. So let's take a look at the core identities, what we're dealing with. We're dealing with SPYI, the NEOS S&P 500 High Income ETF. Their design is for income first. It's designed to extract the maximum monthly cash from the S&P 500. It really targets investors in the retirees that needing immediate and high efficiency cash flow versus the Goldman Sachs S&P 500 Core Premium Income ETF, GPIX. Now this one has that growth focused with income. It's a balanced compromise between dividend yield and capital appreciation. The target investor is the accumulators and the balanced retirees seeking inflation protection. The fundamental difference in philosophy changes everything, depending on your retirement timeline. When I did this research, I started looking at this, and I really kind of why I put this in there so early in the show is it really means where are you at in your retirement? Are you one that needs income and you need all income? Or are you one that needs some growth with some income on the side? So where you put them in your portfolio can really matter. So under the hood is first we're going to start with is the strategy. SPYI is a fully portfolio overwrite. It fully overwrites the entire S&P 500 portfolio. It writes out of the money calls to extract the maximum premiums that they can get. It spreads that structure of buying further out of the money protective calls with part of the premium. So they actually capture about 73% of the market's upside. Okay, but it's consistently, but it is capped. Okay, so that 73% upside capture is consistent, but it's capping it. While GPIX uses a totally different system, which, on some days I say I like it, and other days I don't. But I'm really learning to find out that GPIX, actually this system works the best. It's a dynamic coverage. It writes options only on 25 to 75% of the assets. A large portion of the stocks remain completely uncapped during rallies. So Goldman Sachs' institutional active management approach, the NAV allows to breathe and run during market swings. So 90% plus upside capture because of that flexibility. So again, where are you at in your timeline of retirement? The two different strategies work accordingly. So with GPIX, with only, when things are going really good in the marketplace, they're only writing 25% of the portfolio. They're letting the rest run. When the market's getting in a tough run, they'll cover 75% to generate more income. So when we look a little deeper under the hood, let's break this thing down. SPYI, NEOS, one of the largest funds out there, $9.93 billion in assets. So very, very liquid. The expense ratio is 0.68. We will cover this a little shortly here, but about average from what we've seen. 189 million shares outstanding. It's paid a $6.26 dividend and a yield of 11.81%. Now, this fund came out in August 30th of 2022, but we're going to compare apples and apples. So virtually the same time frames, 1 year. And the fund is run between a $52 to $53 price range with a high of $54.11. Now we look at the bottom chart. Since inception, it had a total return of 14.56%. Over 1 year, 20.06, and year to date, 6.17. With the recent drop-off that we've seen, the back and forth with the war in Iran, you're seeing 0.15 total return in 1 month, which means we've lost some, but the cushion is that big dividend coming back. So quick numbers, 11.81 yield, 1.01 in growth for a total return of 20.06. So you can see why I say if someone's needing immediate money, getting 11% is right in line. Now, when we move to Goldman Sachs GPIX, 4.25 billion. So realistically, about half the size of NEOS's SPYI. The expense ratio, though, is 0.29. So that's literally almost half of what NEOS is charging. 78 million shares outstanding. They paid $4.45 in dividends, 8.11% yield, paying out monthly. This fund came out October 24 of 2023. So, about a year difference, year and a few months difference between the start dates of these two. The fund range runs between $54 and $55 with a high of 56. So both of them are almost identical in line on that way, which is another reason why I selected these two funds. But here's the big difference, the total returns. Since inception, the fund has hit 23.38%. In 1 year, 23.05, so very close to keeping it accurate. 8.56 year to date and 0.60 for 1 month. So when we take a look at these numbers right off the bat, you're looking at 8.11% yield, 3.92% growth for 23.05%. So our total return is a little bit higher. Our growth is definitely higher, but our yield is considerably down. So again, about balance between the two. So the yield comparison. Now, right off the bat, if you are chasing yields, if you are aggressively going after yields and yields only, you'd be saying NEOS is the winner, we're done, walk away, over with and done with. Because there's about 3.7% difference between the yields as of today, about 3.5% difference, 11.8 to 8.11. Now, again, on this channel, I do not chase yields. It is an important factor, but I don't chase it. And there's reasons for it. So when we look at the yield and income generation, you can see SPYI really dominates this program at 11 to 12% yield. GPIX comes in with an 8 to 8.5%. Now, some people will sit and say, well, 8% is great. 3% more over SPYI is good, but I want the growth from it. That is 100% acceptable across the board. But what I'm really showing you here is that these funds, SPYI is 10 times the Vanguard S&P 500, the VOO. Okay. Now, VOO is not designed for income. It is designed to run the S&P 500 index as a whole. So with monthly distributions from both SPYI and GPIX and that 10 times more yield over VOO, I really believe SPYI wins the maximum immediate cash flow category. So if your sole goal is a medium cash flow, SPYI, we can stop right here, is the undisputed heavyweight. But both funds dwarf that VOO standard dividend. Now, I never have said and never will use VOO as an income piece. It's really a foundation piece. It's a foundation in my portfolio that I run off the S&P 500 and let it roll. But I use the SPYI, GPIX basically off of for my income factors. So that's why these funds fit differently. So income, we're talking SPYI. Now the growth comparison. Now NEOS, remember, is built for income. So their total growth is about 1.01 over the past 12 months. Now Goldman Sachs GPIX, again, here we go, is almost 4 times the difference, 3.92%. So basically, if you did this over a longer period of time, you would see over 1 year, definitely a big difference, a couple $100 difference between the two funds. So they have strong growth in monthly income in NEOS, but you have that steady growth and that global exposure into the GPIX to give you exactly what you're looking for. So the NAV growth and the capital capture. Now, SPYI, like I said, again, 73% upside capture because they're trying to get income. They're capping the top end because they're selling those covered calls and out of the money calls or at the money calls on the entire portfolio. Now, GPIX does not, and you can see the difference. You see it in the numbers. That 73 to 90% makes for a huge difference between the two funds. Now, the big number I always look at, total returns. This tells you a lot about a particular fund. And in our total return, look at what we have. SPYI comes in at 20.06%, while GPIX comes in at 23.05. So a 3% difference between the two funds in total returns. So is 3% going to make that big of a difference? I keep going to hound on that same comment that I made at the very beginning of the video. Where are you at in your retirement age? If you're starting off and you still want some growth and you want some income, boom, let's talk right here. This is where GPIX comes in. If you want income all the way through, SPYI pays more and helps out equally. So that 3%, yeah, it can make a difference, but that 3% is primarily built off of growth away from income versus income on the other side. Look at the total trend on the returns. And I really laughed at this one because the numbers came in exactly how I talked about, exactly the way we looked at it. It's the 10% total return higher with GPIX than SPYI. Now, they're both definitely with the benchmark well above the VOO benchmark, but you can see that GPX definitely wins because of their strategy that they use. So that little percentage difference in the income versus what SPYI gave you, and then the GPX does, you're getting growth versus some income versus income plus some growth. Now we get into the fee factor. And I said earlier, we'd get into this. Look at the difference between the two. Now, all the numbers I gave you so far up to date includes all these numbers. So you can see where there's a big difference into it. But SPYI has a 0.68% versus the 0.29% from GPIX. That is a huge difference between the two. Okay. And that 0.39% difference costs you about $1,950 per year in savings. That means you have more money working for you into the future. So there's a lot of things that you can talk about. And really, I think this is one of the big factors is that expense ratio. So when you start adding all these things together, you start seeing a bigger picture. But now the tax efficiency. Now this, I know. SPYI NEOS, we've covered this a lot, has been one of the big advantages of SPYI. It's designed for tax efficiency. First, they use those 1256 contracts. that 60-40 rule. That 60% of the fund is long-term capital gains, 40% is done by short-term capital gains. It does make a big difference. Second, they use return of capital. This is the one a lot of people didn't understand and know when I talked about the Neos family, that they actually still use return of capital, which helps break down anything left over across the board. Plus, they use active tax loss harvesting. Now you ask, what is that? Well, basically the tax loss harvesting is they're going to sell off when they have items that maybe have lost money. They'll sell those off to gain tax advantage and have opportunity in their gains. So the three-step factor to this gives you the minimizing your tax burden across the board. And this has been a big selling feature of SPYI for years. And I agree with 100% that their way of doing it. So if you're in a brokerage account, not an IRA or a Roth fund, this is critical information for you. This is very important for you, that you need to have this type of tax efficiency. And it's nice that the fund does it all on its own and you're very comfortable across the board. Now, GPIX, this is where it really steps up. They actually flip what they do. Number one is their heavy reliance on return of capital. Okay, historically, 85 to 95% of their distributions come to you at the end of the year, the 1099 DIV, as capital return of capital. And that kicks, I always call it, kicks the can down the road on your taxes until you virtually sell the fund. But you know, they also, it's a crazy point, they also use the 1256 index option. So they have just the same thing that SPYI has. Though they use more return of capital up front than using the 1256 sections. But basically what it does is designed to deliver higher income today while maximizing your tax efficiency. So both funds are working towards you on your tax approach. So like I said, SPYI and GPIX heavily emphasize tax efficiency to avoid that high ordinary income taxes that plague standard covered call funds. It handles taxes through two premium mechanisms, and that is the return of capital and the Section 1256 we call the 60-40 rule. Very, very important here that both funds are really tax efficient. So when I sit down and did the head-to-head comparison, I'm like, wow, we got to make a decision here. Which one is actually the best? Well, for distribution yield, you see SPYI is going to win between that 11 and 12% to that 8 to 8.5%. Expense ratio, going to go to Goldman Sachs because of that 0.39% difference. Upside capture, I got to go with GPIX because they have 90% better of that capturing that upside versus the 73% from SPYI. Total returns, I got to go with GPIX because of that 3% difference. And tax efficiencies work equally. So when I really do it, I have to say, see, GPIX sweeps the board. 3 wins to 1 win. Lower fees, higher upside capture, and superior total returns. So it's a big challenge there, which goes back to my original statement. Where are you at in your retirement lifespan? Are you needing income? Now, I'm going to give you my own personal side of it. I live off of this stuff. I've lived off it for over 10 plus years. So that 11% means a lot to me. So I did, if you don't understand and what I've done, I did a very clear factor. I have a 3-bucket portfolio, a foundation fund, which VOO is part of. I use a growth fund, and I'm going to have to tell you guys right now, my GPIX is actually in my growth fund. Because of that 90% upside, I want that to continue to grow bigger, and I take that yield And I make a decision each month. Do I need it? I'll roll it into my income fund. If I don't, I drip it and buy more GPIX to grow even more. And then I take that 11% SPYI and put it in my income bucket and work accordingly. So if you are in for income, SPYI. If you want to do something in the growth side of it, GPIX works actually in growth or the income bucket accordingly. So the final verdict and the decision side of things that we look at. If you're going to choose SPYI, the drawdown phase, that's when you're living purely on income, already retired and actively drawing from your IRA. SPYI is definitely a fund to have it in. Maximize that immediate cash flow is your primary need, and living expenses funded directly by monthly distributions. Exactly what I just said. That's how I use it. Now you want to choose GPIX if you're still accumulating phase. If you are still in the wealth accumulation phase and you want principal to keep pace with inflation over the next 20, 30 years. The value lowered fees compounding over decades, that 0.039 is not going to make that huge of a difference in 1 year, 2 years, 3 years. But man, you do that over a 10, 20-year period, definitely a huge difference. If you want institutional grade management without the tax complications, this steps up to big time. Or if you use it like I do as your growth fund to help continue that growth over the inflationary times, fits in very well. So GPIX is the smarter, more mathematical efficiency choice in most IRAs and Roth investors. Because again, the lower fees, the higher upside capture, and the tax side of things come into play. But again, once you move over, you need that income, you need that 3% can make a huge difference. SPYI would be where you move it to. So the question and conclusion I give you guys, I just want to show you, yield is not everything. I talked to a lot of people. They always want to talk about yield, 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 yield. And I agree with them that yield is a big factor, but not all the answer to the magic question. High yield alone is the wrong metric inside a tax shelter account. That GPIX wins on what matters: superior total return, lower fees, and higher upside capture. And I like it because they're watching it as the market changes. They're changing with the market. Plus, you got the whole tax shelter already built in, which is the premium the SPYI does, apple for apple there. And then, of course, know your draw line, know your timelines. Drawdown phase, SPYI fits. GPIX more that superior engine across the board. But the covered call ETFs are very, very powerful tools. But they must fit your specific timelines, account type, and choose the right engine for the right job. So I'm going to ask you this. Where do you feel this fits? How do you see this? Do you use both like I do? Are you all SPYI? Or are you into all GPIX? Tell me how you see this working for you and in your portfolio. I love to hear you see the comparison. Maybe I'm doing something wrong, but across the board, I think both of these fit very, very well into retirement packages, just using the right tool for the right job. Let me know in your comments below, and hopefully, if you like what we're doing, hit that like button. It helps us the most.
Thank you for watching. Press the